Hello and welcome to Credit Compass, your guide to navigating European credit markets. My apologies for the slight delay to this edition. I've been enjoying the slopes in France while markets, rather less peacefully, had to digest a new geopolitical shock. The original plan for this week had to change slightly and quickly. Today we'll cover the market impact of the escalating conflict involving Iran and what it means for European credit. We'll also examine what could be Europe's first recent cockroach moment in non-bank lending and revisit concerns around AI-driven disruption, particularly in software, and how all of this feeds into credit spreads, risk premiums, and credit selection. All right, let's dig in. First, the escalating conflict involving Iran and its potential impact on European markets. From a European perspective, the transmission channel is primarily energy. Europe remains a structural energy importer, particularly in natural gas, and any disruption to oil or gas production, shipping routes, or regional stability risks pushing energy prices higher. Europe has already struggled to normalize energy costs following the Russia-Ukraine conflict, so while oil price sensitivity to inflation has declined relative to prior decades, energy remains a key input cost for industry and a direct burden on consumers. So, how does this feed through? First of all, growth. Rising energy prices act as a tax on the economy. For corporates, higher input costs compress margins unless pricing power is strong. For households, higher utility and fuel costs reduce discretionary spending. Both effects slow the recovery that had begun to take hold. Further, this conflict will raise the political impetus to improve energy independence for the region. Second, sectoral pressure, particularly in the chemical sector. Germany's chemical sector remains a critical industrial pillar. These companies rely heavily on petroleum-based feedstocks. They were already navigating elevated energy costs and a weaker global demand. A renewed energy spike complicates that recovery path and pressures credit metrics for the weaker players. Thirdly, inflation and rates. As KBRA noted in prior research, which you can find on KBRA.com, the pass-through from oil prices to inflation in Europe is less pronounced than in past decades, but it is not zero. A sustained rise in energy costs could shift market expectations from rate cuts toward a prolonged hold or even a more hawkish bias. In the UK, expectations for near-term rate cuts may now be pushed out, pending clarity on the duration and the scale of the conflict. For credit markets, the immediate impact is straightforward. Uncertainty widens spreads. We are likely to see a pause or slowing in primary market activity as issuers and investors reassess risk. Spreads have reacted with volatility, widening and partially retracing. Equity markets have been more reactive even still. In credit, geopolitical risk rarely causes immediate systemic stress, but it does raise required compensation for risk. And that brings us to what may be Europe's first recent cockroach moment. I personally don't really like the term, but Jamie Dimon once said, "There's never just one cockroach." The comment has become shorthand in credit markets for hidden fragilities, problems that surface one at a time, but may signal something broader underneath. In the United States, two borrower situations unsettled investors in 2025. However, the prevailing view, including ours, was that these were idiosyncratic rather than systemic. That has proven to be the case so far. Risk managers have since combed through portfolios, stress-tested exposures, and largely concluded that the issues were contained. Now, we have a development in London that serves as a reminder. Idiosyncratic event and fragilities will always exist in credit. In particular, operational and management risk can be masked. Market Financial Solutions, or MFS, a non-bank lender active in UK property finance, has been accused of double-pledging loans in its financing arrangements. The details are still being established, and it is important not to prejudge outcomes. But even the administration and allegation is enough to focus attention on operational and governance risk within non-bank credit. The firm specializes in bridging loans or short-term collateral-backed financing provided to property developers between acquisition, renovation, and sale. Bridging finance is common in UK real estate. It fills a liquidity gap where traditional banks may be unwilling or unable to lend quickly. Since the global financial crisis, this segment has increasingly migrated to non-bank lenders. Regulatory changes pushed banks towards higher capital requirements and more conservative underwriting. Non-bank lenders stepped in to meet the demand. In many cases today, banks provide funding lines, warehouse facilities, or term financing to non-bank originators rather than underwriting directly. That means banks may be one step removed from the collateral and, as a result, increasingly reliant upon management. The underlying collateral might be sound, but the governance, reporting, and internal controls of the non-bank lender become a critical risk variable. If a non-bank lender misrepresents collateral or pledges it multiple times, the issue is not necessarily a macroeconomic indication of endemic stress, it is operational. But operational failures can transmit quickly through funding markets. Our base case remains that this is an isolated incident rather than evidence of systemic weakness in European credit. The firm has operated since 2006, which suggests this is unlikely to be a flash-in-the-pan structure built solely for arbitrage. Perhaps this is an incident to help usher in greater use of smart contracts where the prospect for this type of double pledging is more difficult. However, the timing is not ideal for credit markets in Europe. European credit spreads had already begun to drift wider before the story broke and rise even wider after the Iranian conflict. Risk sentiment has been fragile. When markets are cautious, even idiosyncratic headlines can reinforce defensive positioning. And that brings us to the third pillar of this week's discussion: AI disruption and software credit risk. Over recent weeks, software equities experienced renewed volatility, in part following the circulation of a widely discussed research note titled "The 2028 Global Intelligence Crisis" from a Substack commentator. By the way, we are on Substack too. Look me up and follow if you prefer to read this podcast. The piece sketches a future scenario in which rapid advances in artificial intelligence compress software margins, erode pricing power, and accelerate product obsolescence. It is important to frame this correctly. The note is speculative, but the reaction reveals something deeper. Investors are grappling with the speed of technological change and its implications for cash flow durability. For credit investors, the transmission mechanism is straightforward. If AI materially reduces switching costs, compresses margins, or shortens product cycles, then earnings, or EBITDA, stability could weaken. In leveraged finance, durability of cash flow matters more than growth. A high-growth software company can still be a weak credit if its competitive moat erodes quickly. From the perspective of large private credit managers, the public message has been cautious but somewhat reassuring. Blackstone's chief credit investment officer has emphasized that their software portfolio companies are growing and well-capitalized. Ares CEO Michael Arouheti has publicly pushed back against what he describes as overblown narrative around underwriting deterioration in private credit. And indeed, if we look at Europe's public markets, the data does not suggest systemic stress. In the Pan-European High Yield Index, excluding financials, technology represents roughly 4% of the index. That's a relatively modest weight. Only one issuer in that segment is trading at a price below 80, a commonly used, though imperfect, distressed threshold. In leveraged loans, exposure is higher. Technology accounts for approximately 12.5% of the European leveraged loan index. Of the 62 issuers in that sector, 7 are trading below 80. That suggests pockets of stress, but not a broad collapse. A recent Deutsche Bank note on European leveraged finance offers a nuanced interpretation. Defaults are not surging. Instead, stress appears to be concentrating in the weakest credits. Within the CLO market, the largest investor base for European leveraged loans, CCC exposures are flat to slightly increasing. Compared with 2025, the increase is not sharp, but importantly, those levels are not trending downward either. At the same time, the share of B- rated loans has been declining. However, a meaningful portion of that B- cohort sits within the under stress sectors of softwares and chemicals, together representing roughly a quarter of that rating bucket. So what does this tell us? We are not seeing systemic contagion, we are seeing dispersion. The weakest credits, those with thin margin, high leverage, or challenged business models, are experiencing pressure and struggling to improve. Stronger credits have stronger business models and continue to have access to capital markets and are able to refinance. This is consistent with a late cycle credit environment where liquidity is available but selective. Now, let's turn to something that's been a little more positive in Europe lately: corporate fundamentals. As of late February, more than half of Eurostoxx 600 companies have reported full year 2025 results. Revenues have modestly exceeded expectations by just over 1%, and earnings have also surprised slightly to the upside. Financials have been the standout sector, benefiting from net interest margins and resilient balance sheets. Utilities and real estate have also contributed positively to earnings growth. Materials and communications have lagged, particularly on the earnings front. Importantly, aggregate earnings growth across the index has been in the double digits, supported by operating leverage and cost discipline. This creates an interesting tension. On one hand, backward-looking fundamentals are improving. Corporate earnings are stabilizing. Leverage metrics in many sectors are manageable. Refinancing windows remain open for higher quality borrowers. On the other hand, forward-looking risk premiums are adjusting to structural uncertainty, particularly around the impact of further global conflict, AI disruption, and competitive dynamics in technology-heavy sectors. What we may be witnessing is the emergence of both a global uncertainty premium and an AI disruption premium, a widening in spreads not because of current cash flow weakness, but because of uncertainty about the durability of future earnings. In credit, uncertainty itself carries a cost. Our base case remains constructive on credit generally. High yields, even if with tight spreads, offer an attractive alternative to high equity valuations. However, the uncertainty premium is likely to prevail and may even get larger if energy prices remain elevated. The UK non-bank situation appears idiosyncratic rather than systemic. AI disruption, while real, is unlikely to erase software cash flows overnight. European corporate earnings are showing resilience, but the prospect for greater problems as a result of rising energy costs is a concern. Dispersion will likely increase as certain sectors are able to weather this disruption better than others. In this environment, credit selection matters more than beta exposure. Strong balance sheets, conservative leverage, diversified revenue streams, and a clear competitive positioning will differentiate performance. The key for credit investors is discipline, separating signal from noise and distinguishing between temporary volatility and structural impairment. That's all for this week's edition of Credit Compass. If you found today's discussion insightful, please follow, rate, and share the show. It helps others to discover it. For deeper insights and data-driven analysis on macro and credit trends, please visit kbra.com/macro credit. Until next time, stay curious, stay informed, and stay resilient. Let Credit Compass help guide your way.